Good morning. It's live with Mercy and Rita. Hashtag Mercy.
Hashtag Rita.
I don't know what that is.
Hashtag nerd.
Hashtag nerd is what.
Okay,
Gotcha.
if you guys could just see what happened right before this video, you'd be so surprised. Paul Brewbaker is back with us from TZ Economics. We're so grateful. You are still the highest open of videos that we've had all year.
Oh.
The last time we gathered together, which was in July,
Yeah.
the Chinese stock market was a little fishy. Greece was kind of going a little under.
Was the word.
The U.S. stock market was a little scary. You use words such as bubblicious, the long-term glide path, steady eddy, the monetary policy, which I know you're going to talk about, and we even throughout the year 2020. So we're going to ask you for a little bit of a recap and what to expect and what things that agents or lenders can look for in 2016.
Okay, well, let's recap in terms of where we were and where we've arrived. So in July, the Chinese stock market had just begun to blow off a bubble in equity valuations. And that actually accelerated in August and began to drag down stock prices in the US and elsewhere. So, and then there's kind of a hard bounce after that in September, leading the Fed to defer a decision on changing monetary policy with specific reference to global financial market conditions. By that time, Greece had faded. Greece made certain decisions that, resolved in whatever way things were or weren't resolved their situation with respect to the rest of the European community. But meanwhile, this downward drag from Chinese equity valuations really began to disrupt the economy, the global economy in the third quarter. And things have settled down after that. U.S. equity valuations have sort of come back to where they were prior to the China syndrome. But I think at this point, even though we expect monetary policy to move forward with normalization next week,
Meaning, interest rates will increase?
Interest rates will start to rise,
Okay.
presumably gradually at first, but maybe at some point down the road a little faster. At any rate, normalization, whatever Janet Yellen is going to explain to us, means, whatever it means, it does mean higher interest rates in the future and a little bit of a headwind on real estate valuations and real estate transactions volumes.
And what are the things that agents, lenders, or principals can look for next year in the real estate market?
Well, the interest rate story is probably initially the most interesting one to be paying attention to. I think now that we're at the 1-year anniversary of declining oil prices, the other thing that may surprise people, although it really shouldn't, is that having fallen, oil prices did provide a tailwind for the economy, especially Hawaii, in the last 12 months. But going forward, at $40 a barrel, the price today is the same essentially as it was a year ago. So the disinflationary impact of that will dissipate, and we'll see inflation, overall inflation, go back to a range around 2% that the Fed has been looking for and has a guided policy towards.
With the interest rates rising, how do you see that affecting
Real estate
maybe
prices.
number of sales or
Real estate prices.
Well, the fact is that we've enjoyed a tremendous window of opportunity for many years for low interest rate, mortgage interest rate financing, and that will go away. The question is, by how much will mortgage rates rise and how much of an impact will that have? I would guess all in over maybe a period of 2 years or more, 100 basis points, a full percentage point higher rates might be where we end up. It's not that much considering where we start and considering that it's going to move gradually. I think the risk at the long end of the yield curve, or in terms of long-term maturities like mortgage pricing, those rates may move up faster than the short-term rates. Right, the Fed controls the short-term rate, but the longer-term rates may just move, to the end in anticipation of where the Fed is going to end up.
so then would you say 2016 is still a steady eddy glide path as you had initially said back in July?
Sure. I mean, we're settling into a glide path that is dictated by the expectation of somewhat higher interest rates in the future than those that we've had, which means home prices probably aren't going to rise as fast. That was probably going to happen anyway, since we came off a hard bounce out of the recession. But also because in a world in which everything's sort of normalized, long-term treasury yields, let's say 3.5%, mortgage financing, let's say 5.5%, maybe that kind of number. It's not going to kill anybody, but it's a little heavier burden on the economy going forward. And then we have these things out there in the rest of the world. The emerging markets have had a bad run, and it remains to be seen how much unraveling there will occur beyond what has already happened in Brazil or Russia. Now China is a big question, and I think people haven't paid enough attention to India. And that we're going to go into an electoral cycle in the United States that may or may not change fiscal policy direction. So a lot of uncertainty, maybe in place of what had been a kind of a carefree environment with things very helpfully aligned in terms of where interest rates were and where policymakers, at least monetary policymakers, were focused. In the conduct of monetary policy.
Okay. You know what? That is a great recap and update, Paul. We cannot thank you enough for coming.
Thank you so much.
My
And
pleasure.
again, just a reminder that all our informational videos, you're more than happy to share that on your social media. If you click right above, you'll see all the social media buttons, and right below, you'll see all the industry news and our stats, and that's for you to use. So thank you again for watching Live with Mercy and Rita. #Mercy.
Thank you, #nerd, for coming. #Fidelity Maui.
Hashtag
Troublemaker. See ya.